In this video, traders, I'm going to show you a system that is so simple that anyone can trade it. So let's begin. Please subscribe to the channel and hit the bell icon so you get notification every time there's a new video. This is a simple system that you can apply to daily charts. You can replicate it on Mt4, eSignal, TradeStation, TradingView, any platform that you like. So the trend is established by following the moving average, and the entry signals are created using two candle patterns. A normal candle, a bearish candle. This next candle is an inside candle. And this is a trend line or a moving average. This trend line suggests that the market is trending up. When price comes to the trend line, bounces off it, and then creates an inside candle, that is your buy signal. And the reverse would apply to a sell signal. So we have a normal candle followed by an inside candle. Prices bounce off the trend line. This becomes your sell signal. So this is a Mt4 chart that I've created. What you see is a purple line. The purple line is our moving average, which will establish the trend. The settings for the purple are 34 simple moving average. You can give it any color and style you like, but the MA method should be simple and apply to median price. What you see here is an inside candle. This is also an inside candle. This is where the pandemic started, but before that, market was already trending down because price was below the simple moving average. You have one signal here, you have another signal here which wasn't triggered, there's another signal here and another here. This one is a bit too big, but it was a signal that didn't trigger. This is a signal that did not trigger. This signal also did not trigger because the next candle did not break the low of this candle. But this candle is the perfect signal because you have a small range of it. What you would do is that when you see this candle and price has bounced off the simple moving average, you wait for your signal, not somewhere here, but close to the moving average. You calculate your lot size based on the range of this candle. Go 2 to 3 or maybe 5 pips below the candle, and your stop loss about 5 pips above the candle. Risk 1% on this, and as this market goes, you have two choices to make. Either you trail the candle and or you set up a 1:5 or a 1:3 target point. In this case, if you trail the candles, you got yourself about 400 or 500 pips at the risk of around 75 pip stop loss. So what is that? 500 is your profit, 75 was your stop loss. You got 1:6.6. So had you risked $100 here, about 1, 2, 3, 4, 5, 6, 7, and 8 days later, if you are trailing actually here, this would have stopped you out. You got 400 or 500 pips, let's call it 490 approximate, in under 5 days. So if it's not 1:6, it's 1:5. So you could have turned $1,000 into $5,000 in 5 days, or $100 into $500. Here's another example. The second method of exiting the trades is basically to take a trade based on the inside candle. Make sure that the candle before that is a trending candle. So this is a bullish candle followed by an inside candle. This is a better setup. So if you want to stay in the trend for longer, you take a trade above this candle, stop loss below this. When it goes 1 ratio or 2 ratios in your favor, you close half and you leave the stop loss at the original spot. Then you begin to trail the 34 SMA. you will not get out unless it closes below this. So for this signal, your stop loss requirement was 65. Let's call it 70. So if this is 70, you are right now with a profit of 680. So what is that? Let's call it 650 divided by 75. So that's 1:8. So you risked around 100 here, and around 1:2 you closed half. So you have banked 1%. And after that, you have then gained another 8 hours. And this trend can continue and go. This is a very good example because with one chart, I can show you both of the possible options of exiting. So in this case, as you saw, the market moved really strongly down, and that created this particular triangle. Let me draw that for you. This created this triangle space between this. So what you need to do is that if price has gone too far from the moving average, then you know that if it moves away from the moving average, it is highly likely that it will snap back. In certain conditions, you can also take reversal trades, which was offered here. So you have a bullish candle followed by an inside candle. You took the range of this and you take the trade back to the moving average, or if it crosses above it, then you convert your trade to simply following the simple moving average. Now let's look at another example. All the charts that I have right now have all these examples. So this is Australian dollar yen. They have similar examples. See, on this occasion, it bounces off the simple moving average, but you have a bullish candle. So it was a little bit iffy because it's also for the previous price action is a little bit sideways. As you can see on this one, this would have gone one ratio in your favor and then closed you. So it could have been a losing trade, but that doesn't matter. About 50% of losing trades, but the winning trades are so big that the losing trades don't really matter in the long run. So this trade, that if you took it here, required only 50 stop loss, and then it goes up. So you would have trailed these candles. Why? Because you have this big distance between price and the moving average. But in case you followed the simple moving average, you're still in this trade. Let's go to Euro USD. So the Euro USD broke out here, went up and came down. I want to show you this candle. These are not the type of inside candles you want to take. Why? Because the range of this candle is almost equal to the range of the candle before, and it's not a small candle. It is a large candle, large bullish candle. We don't want candles like those. We want them smaller, possibly doji candles like this one. If you took this one, you probably got kicked out because of this one. But if you took this candle and you had, let's say, 5 buffer, you would have survived. So probably a little bit of frustration on this one. Let's look at the Euro Yen. The Euro Yen presented quite a few signals, so these ones you won't take because these are fairly large candles. Here you would have been ready for a long signal, but still it's a very large candle. This one is pretty good because it's a doji and it's an inside candle and it's out after a bounce, and the direction of the moving average is down. It's trending down and the price is below it. You would have taken this trade, and if you stayed in it, you probably got out here when there was a bit of angle between price and the moving average if you didn't exit here. And if you didn't exit here, then you got out here with a small profit. But after that, as it crossed up and pulled back towards it, you have another small seed or inside candle. 50 stop loss, and you got yourself 580. So that's around 1:10 trade within 9 to 8 days. See again here, this is an inside candle. The range of it is 135 pips. It's really not a consolidation day. It is a bullish candle, not an inside candle. This one also is pretty good, but it will not be taken. So if the market breaks the low of a bullish signal, but then comes back and closes within the range of the inside candle, you can still take the trade based on here. So you will take your pending order above here, and stop loss will be then below the low of this candle. So that will be 105 stop loss, and you would still be in this trade, or you got out because of the angle that is created between moving average and price. You probably trailed the candles and you got out there. Let's look at another example. Let's look at the pound yen. Suppose in May 2019 you saw this bounce. You either took this signal, or if you waited for price, these are the things that we need to consider. If the market is sideways, box like this, you want the price to break out of it. So it broke out and it gave you a little tiny signal here. That's 80 pips stop loss. And then if you follow the simple moving average close, then you would have got out here. So you would have taken 1180 pips. So how much is that? That's 1:14. Now it did take 3 months or maybe 4, but you didn't have to do anything. Mind you, you have other signals here. So the best strategy, risk management wise, is to apply the closing half method, which I call the free trade method. So if you took this signal and price went 80 in your favor, you close half, leaving the stop loss at the original. Now this is a free trade. So if you took the next signal as well, and that moved in your favor, and you converted that to a free trade, now you have 2 trades running. Suppose you took a third one here, because you're now in quite a lot of profit from these early 2 signals, you can risk another 1% here. This turned into a free trade, and now you let that run as well. Then you took this one, this signal, or this one, turned into a free trade. You also took this one. Then if closed here, you didn't have 1:14, but instead you had 1:14 from that one. That's, let's say, 90, and you got let's say 1,000. So let's call it 1:10. These 2 signals together gave you 1:24. Just these 2, not mentioning the others. You do the rest of the count. So this is a very, very simple strategy that anyone can trade by looking at the end of the day markets, at the close of the day, when the candle closes, or just before the candle closes. You will know if it's an inside candle or not. That's the way to trade this. This is a very, very hugely profitable trading strategy. I know some people would like to apply it to the hourly or the 4-hourly charts, and you can do that. But if you do it on the daily chart, it is the most stress-free and simplest way of trading. Just make sure that when you're taking signals, that the angle of the moving average and price is either down for sell signals or up for buy signals. I hope you like this strategy and you give it a try, or at least give it back testing, and give us a thumbs up if you like this video. And if you would like more videos like this, please do let me know in the comment section. I have many more strategies that I can share. So thank you very much. I know there are a lot of other strategies based on the candle patterns, but this is the one that I have used, and I have back tested this for quite a while. I hope you find value in this. You take it for a ride, give it a test, not on a real account, at least on a demo account, for a few months. I'm sure you will not be disappointed. So thank you for tuning in, and see you in the next video.
Thank you for watching. I hope you liked this video, and if yes, please hit the like button. Do you have any questions or ideas for upcoming videos? Then leave a comment. Also subscribe to the channel and hit the bell icon so that you never miss any future videos. See you next time.